Something unprecedented is unfolding in the silver market right now, and what I am about to reveal could fundamentally transform how you understand money, commodities, and the hidden fractures running through our global financial system. Silver smashed through $115 per ounce this week. Stop everything and absorb that number for a moment. Just 12 months ago, this exact metal traded around $30. In one single year, silver delivered a 270% return. Not Bitcoin, not Nvidia, not gold. Silver, the metal most people ignore, outperformed every major asset class on the planet. But the price is merely a symptom. The underlying disease runs far deeper, spreading across continents, and what just happened in China might be the clearest warning sign we have received about structural problems that extend well beyond any single commodity market. Let me show you exactly what I mean. China operates only one publicly traded fund that grants retail investors direct exposure to silver futures. The UBS SDIC Silver Futures Fund became ground zero for the most aggressive precious metals buying frenzy in modern Chinese financial history. Tens of millions of individual investors, many driven by social media recommendations and viral investment discussions, stampeded into this single investment vehicle. The result was market dysfunction on a scale regulators had never witnessed. The fund's trading price detached completely from the actual value of silver it held. At the peak of the frenzy, investors willingly paid a 62% premium above net asset value. Break that down in concrete terms. For every $100 of silver exposure the fund genuinely contained, desperate buyers were handing over $162. The premium alone exceeded many annual investment returns. People were paying that much extra simply for the privilege of gaining any silver exposure through available channels. Chinese authorities responded with increasingly aggressive interventions. The fund hit its maximum permissible 10% daily price increase for 3 consecutive trading sessions. Fund managers issued 15 separate risk warnings during January alone, essentially begging investors to recognize the danger. Subscription limits were slashed to 100 yuan per investor, roughly $14. Making it nearly impossible to establish meaningful new positions. Trading was suspended multiple times throughout the month as the exchange attempted to restore order. And ultimately, this week brought the final drastic action. The fund closed entirely to new subscriptions, rejecting every single investor attempting to gain exposure. Consider what this means. A financial product was forced to shut its doors not because of fraud, not because of mismanagement, not because of performance failure, but because demand became so overwhelming that allowing continued access risked broader systemic instability. This was an emergency measure taken because the alternative, unconstrained buying, threatened contagion effects throughout Chinese financial markets. Now understand why this frenzy erupted, because the catalyst reveals something far more significant. On January 1st, Beijing officially activated export restrictions on silver. The Chinese government classified silver alongside rare earth minerals as a strategic resource requiring special government licenses before any international shipment. Reports indicate that export volumes have collapsed approximately 40% compared to the same period last year. Licenses have become exceptionally difficult to obtain. China ranks as the world's second-largest silver producer. Historically, Chinese refineries supplied substantial quantities to global markets. That supply pipeline has now constricted severely, perhaps permanently. Market analysts coined a term for this policy shift: the Great Silver Wall. The consequences are already manifesting in price differentials that defy all historical norms. Shanghai silver currently trades at a premium of nearly $17 per ounce above London benchmark prices. Consider the math. If London silver costs $115, Shanghai silver costs $132. Even after accounting for China's 13% value-added tax on precious metals, the domestic premium remains unprecedented. This spread demonstrates that available supply within China cannot satisfy its own domestic demand, let alone permit meaningful exports to the rest of the world. The behavioral responses provide even more vivid evidence. Chinese manufacturers have reportedly pivoted entire production lines away from jewelry manufacturing toward fabricating 1-kilogram silver bars designed specifically for investor storage. When an industrial sector fundamentally reshapes its manufacturing focus to accommodate speculative investment demand, the supply-demand imbalance has reached critical intensity. This is not normal market activity. This is adaptation to extreme conditions. Events in Shenzhen add tangible human evidence to the abstract market dynamics. Shenzhen hosts China's largest physical bullion marketplace, a sprawling hub where dealers trade precious metals at massive scale. This month, a major silver dealer in the city's Shuibei market defaulted on customer deliveries. Over 350 individuals are reportedly awaiting compensation for orders that could not be fulfilled. They paid money. They expected silver. The seller lacked sufficient inventory to deliver. This is not derivatives trading on computer screens. Real people with real money attempted to purchase physical metal, and the counterparty simply did not possess enough silver to meet the obligations. When deliveries fail at this scale, something has broken in the underlying supply chain. Now project these dynamics onto the global stage and examine what Wall Street's largest institutions announced this week. Citigroup raised its 0 to 3-month silver price forecast to $150 per ounce. That represents a 50% increase from their previous target of $100. Their commodity analysts stated unambiguously that they have maintained bullish positioning on silver relative to gold for many months and expect this outperformance to continue into the coming weeks. When one of the world's most powerful financial institutions upgrades price targets by 50% within a month, the underlying analysis has shifted dramatically. Bank of America went even further. Michael Widmer, their head of commodities research, outlined a scenario where silver reaches $170 per ounce within 2 years. The condition: retail investor accumulation must continue at the pace observed during late 2025. If social media enthusiasm keeps driving individual investors into silver positions, if coin and bar demand maintains its torrid pace, if ETF inflows remain robust, then $170 becomes achievable in Widmer's models. That target implies roughly 50% additional upside from already historically elevated levels. Consider what that would mean. Silver would have appreciated from $30 to $170 in just over 2 years, delivering a 460% gain that would make most venture capital investments look pedestrian. However, Widmer delivered an equally critical warning that balances the bullish headlines. Bank of America's internal fundamental models estimate that the fair value for silver, based on traditional drivers like industrial production, ETF flows, and dollar strength, sits closer to $60 per ounce under current conditions. The gap between $60 fair value and $115 market price represents an extreme speculative premium approaching 100% above justified levels. Widmer explicitly cautioned about violent price swings in both directions. What ascends in parabolic fashion often corrects with comparable intensity. Investors entering at current levels should prepare psychologically for potential drawdowns of 30, 40, even 50% without the fundamental thesis necessarily being invalidated. Goldman Sachs provided the crucial structural analysis explaining the mechanics behind this extraordinary volatility. Their research team identified an emerging liquidity squeeze centered in London, the historic hub for global silver pricing and physical storage. For centuries, London has functioned as the clearinghouse for precious metals trading worldwide. Banks and dealers hold inventory in London vaults to facilitate transactions. Prices are set in London based on available supply meeting stated demand, but inventories in London vaults have thinned substantially over recent months. Goldman explained the catalyst: fear that silver might eventually face import tariffs under shifting American trade policy prompted traders to relocate physical metal from London into United States warehouses. Each shipment drained London's stockpiles. The cumulative effect created structural tightness at the very location where global prices are determined. Goldman's analysts characterized the result bluntly: thinner inventories have created conditions for squeezes, where normal trading flows produce outsized price movements because insufficient buffer stock exists to absorb buying or selling pressure. When a buyer wants 10 million ounces and only 5 million are readily available, price must adjust dramatically to locate additional supply. When a seller wants to exit and no buyer sits ready at current prices, bids evaporate. Visualize the mechanics through analogy. The silver market historically functioned like a 4-lane superhighway. Traffic flowed smoothly in both directions. Vehicles could pass, merge, and exit without significant congestion. Now imagine 2 lanes have been permanently closed while traffic volume actually increased. The same number of vehicles trying to navigate through reduced capacity creates massive congestion, sudden braking, and unpredictable acceleration. That is precisely what Goldman described: structural tightness amplifying every directional move, making the ride far more volatile regardless of which direction you are traveling. This brings us to the Federal Reserve, whose two-day policy meeting began today. Financial markets widely expect interest rates to remain unchanged at this gathering. The Fed has maintained its benchmark rate for several meetings, and economic data provides no urgent case for either cuts or hikes. However, the significant variable extends beyond the rate decision itself to Fed Chair Jerome Powell's press conference scheduled for tomorrow afternoon. Powell faces intense scrutiny, not merely about monetary policy, but about something more fundamental: the institution's independence. President Trump has repeatedly attacked the Federal Reserve publicly, questioning Powell's competence and judgment. The administration announced plans to name a new Fed chair imminently, raising questions about whether Powell will serve his full term. Prediction markets show genuine uncertainty about leadership continuity at the world's most powerful central bank. Why does this matter for silver? The connection operates through currency channels. Lower interest rates historically weaken the dollar because reduced yields make dollar-denominated assets less attractive relative to alternatives elsewhere. When the Fed cuts rates or signals accommodation, capital often flows out of dollar holdings seeking better returns, depressing the currency. Precious metals priced in dollars tend to rise when the currency falls, through two complementary mechanisms. First, a weaker dollar makes metals cheaper for foreign buyers, increasing demand. Second, dollar weakness signals broader concerns about American fiscal and monetary stability, prompting flight toward tangible assets perceived as stores of value independent of government policy. The dollar currently trades at four-year lows against major global currencies. Trump's public comments this week amplified the weakness. He explicitly stated he is unconcerned about the dollar's decline, reinforcing market expectations that the administration will not intervene to support currency strength. If Trump views dollar weakness as beneficial for export competitiveness, and if the Fed faces political pressure to accommodate that preference, dollar bears have strong tailwinds. Should tomorrow's Fed communication suggest additional accommodation, acknowledge political constraints, or create uncertainty about institutional independence, dollar weakness could accelerate further. Precious metals would likely benefit directly. This convergence of factors, Chinese supply restrictions, depleted London inventories, surging global retail demand, accelerating dollar weakness, Fed policy uncertainty, and persistent structural deficits, creates market conditions unlike anything silver has experienced in generations. Examine the fundamental supply-demand picture independent of speculative dynamics. Global silver demand has exceeded mine production for 5 consecutive years running. The Silver Institute, the authoritative industry research body, documents annual deficits averaging approximately 170 million ounces. Mining output has plateaued while industrial consumption keeps growing. Why does industrial demand continue rising? The answer lies in technology. Solar panels require silver paste for electrical conductivity. Each gigawatt of solar capacity consumes approximately 1 million ounces of silver. Global solar installations keep setting records as countries pursue renewable energy targets and grid-scale economics improve. Electric vehicles contain multiple silver components, including contacts, switches, and battery management systems. The EV transition means millions of new vehicles each year requiring silver input that internal combustion equivalents did not need. Artificial intelligence requires massive data center infrastructure. Those facilities contain countless servers, switches, and electrical systems utilizing silver for conductivity and reliability. The AI build-out represents one of the largest infrastructure expansions in computing history. Medical devices increasingly leverage silver's antimicrobial properties. Wound dressings, catheters, implants, and diagnostic equipment incorporate silver coatings that prevent infection. Unlike gold, which serves primarily as a monetary asset with minimal industrial application, silver occupies a unique position at the intersection of investment demand and manufacturing necessity. People buy silver because they want hard asset exposure. Industries buy silver because they literally cannot manufacture solar panels, EVs, or servers without it. Mining supply cannot respond quickly to price signals. New silver projects require years of exploration to identify deposits, years of permitting to satisfy environmental and regulatory requirements, years of construction to build processing facilities, and additional time to ramp production to full capacity. the fastest timelines from discovery to meaningful output measure in half decades. Meaningful supply increases from price incentives will not materialize before 2030 at earliest. Recycling provides modest supplemental supply but cannot bridge deficits of current magnitude. Silver recycling rates remain low compared to gold because silver is often embedded in products at concentrations too small to economically recover. Above-ground inventories at major exchanges have been steadily declining for years as industrial and investment demand outpace fresh supply. The 5-year cumulative deficit approaches 1 billion ounces removed from available stockpiles. China's export restrictions add a devastating new variable to these already strained conditions. Removing or restricting supply from the second-largest producer while demand keeps growing mathematically intensifies the imbalance that already existed. There is simply less silver available to satisfy buyers who keep wanting more. Prices must adjust to allocate scarce supply to the highest bidders. Some analysts speculate that other major producing nations might eventually follow China's example. If governments perceive silver as strategically critical for domestic industrial bases, why would they export limited supply rather than reserving it for their own manufacturers? The United States recently added silver to its critical minerals list, explicitly acknowledging resource security concerns. Trading activity this week reinforced how dramatically attention has shifted to this previously obscure market. The CME Metals complex recorded a single-day trading record exceeding 3.3 million contracts, surpassing the previous high set just months earlier in October 2025. Turnover has exploded. The iShares Silver Trust ETF experienced trading volume approaching $40 billion on January 26 alone. That figure rivals the most liquid equity ETFs globally, vehicles tracking the S&P 500 or major tech indices. For a silver fund to match trading activity of the largest stock market products demonstrates that mainstream capital has arrived at scale never before witnessed. But not everyone believes this rally has further room to run. Peter Brandt has traded commodity markets for over 50 years. His track record includes correctly identifying the April 2011 silver top at nearly $50, calling the peak within days of its occurrence. This week, Brandt posted warnings on social media that every silver investor should consider. He observed that nearly 2 years of global silver production traded on exchanges within a single session. The last time volume reached such proportions relative to annual supply was April 25, 2011, the exact day silver peaked before collapsing more than 30% in the weeks that followed. When Brandt sees historical patterns repeating, his concerns merit serious consideration. Marko Kolanovic, formerly chief global market strategist at JP Morgan, sounded similar alarms. He identified multiple potential catalysts that could abruptly reverse the rally. Current silver holders might decide to monetize gains, flooding the market with supply that did not exist yesterday. Exchange administrators could hike margin requirements, forcing leveraged speculators to liquidate positions regardless of their fundamental views. Major mining companies could lock in current elevated prices by hedging future production, effectively adding supply through derivatives markets. Kolanovic reminded followers of an eternal market truth. The most dangerous phrase in investing remains "this time is different." Those words have preceded countless disasters when investors convinced themselves that historical patterns no longer applied. History provides sobering precedent that cannot be dismissed. In 1980, the Hunt brothers of Texas accumulated massive silver positions attempting to corner the market. Prices rocketed from approximately $6 to nearly $50 per ounce in months. Regulators mobilized. Exchanges restricted trading rules. Margin requirements spiked dramatically, sometimes doubling overnight. Silver collapsed to below $11 within months of the peak. The Hunt brothers eventually filed for bankruptcy. Retail investors who bought enthusiastically near highs waited 30 years before prices approached those levels again. 3 decades of dead money for anyone who chased the mania at its height. In 2011, silver again approached $50 amid Federal Reserve quantitative easing, European sovereign debt fears, and general commodity speculation. The Reddit retail trading movement had not yet formed, but speculative enthusiasm ran rampant across precious metals. Exchanges responded by hiking margin requirements multiple times in rapid succession. Each increase forced leveraged traders to either deposit additional capital or liquidate positions. Most chose liquidation. Speculative interest evaporated. Prices fell from $49 to below $27 within 6 months, a decline exceeding 40%. The pattern across both episodes contains consistent elements: parabolic price advance, extreme speculative enthusiasm, eventual regulatory response through margin requirement changes, and sharp reversal that erased much of the gains. Whether the current cycle will follow this exact template remains genuinely uncertain, but dismissing historical precedent entirely seems dangerously naive. Proponents of continued strength emphasize structural differences distinguishing the current move from previous speculative episodes. The supply deficit is documented by independent industry research, persistent across multiple years, and worsening rather than stabilizing. This is not speculative fiction but measurable physical reality. Industrial demand growth continues regardless of investor sentiment, because manufacturing processes require silver input. Factories cannot simply substitute alternative materials overnight when silver becomes expensive. Chinese export restrictions represent deliberate government strategic policy, rather than temporary market dislocations that will self-correct. Beijing classified silver as a strategic resource through formal regulatory channels. Reversal would require policy changes at the highest levels. Central banks globally have been steadily accumulating precious metals as part of de-dollarization strategies aimed at reducing dependence on American financial infrastructure. This represents institutional demand independent of retail speculation. ETF inflows reflect genuine investment demand from individuals who actually want long-term silver exposure rather than purely leveraged speculation through futures contracts that can reverse instantly. Societe Generale analysts quantified the ETF contribution. Since October 2025, 491 tons of silver have flowed into exchange-traded funds globally, bringing total holdings above 26,000 tons. Their analysis attributes roughly 65% of the price appreciation since autumn to these fund flows. Unlike futures positions that can liquidate within hours based on margin calls, ETF holdings represent investors who purchased shares because they want silver exposure and typically maintain positions through volatility. This creates a more stable demand base than pure speculation would provide. Bank of America's Widmer addressed this dichotomy directly in his research. He acknowledged that prices have traveled well beyond fundamental justification through traditional models, but he observed that retail investor psychology, driven by concerns about fiat currency debasement and narratives framing silver as real money, in contrast to government paper, could sustain demand independent of conventional valuation frameworks. If retail accumulation continues at the pace witnessed during the fourth quarter of 2025, Widmer's models suggest $170 prices become achievable even if purely fundamental analysis would never support such levels. Psychology matters. Narratives matter. Collective belief shapes markets as much as spreadsheet calculations. For viewers considering how to navigate this complex environment, several principles warrant careful consideration. Timing perfect entries and exits in volatile markets eludes even professional traders who devote entire careers to the pursuit. Attempting to catch exact bottoms and tops usually results in frustration, regret, or both. Establishing positions gradually through systematic regular investment spreads exposure across different price points and reduces the psychological burden of imperfect timing. Most qualified financial advisors recommend limiting precious metals allocation to 10% or less of total portfolio value. Concentration in any single asset class creates vulnerability to sector-specific risks. Diversification across equities, fixed income, real estate, and alternatives provides stability that single asset focus cannot match. Different silver investment vehicles carry distinct characteristics that suit different objectives. Physical bullion, whether coins manufactured by sovereign mints or bars refined by accredited facilities, eliminates counterparty risk entirely. You hold the metal. No intermediary can default, freeze, or restructure your claim. However, physical ownership requires secure storage, insurance coverage, and acceptance of premiums above spot price plus eventual selling discounts below spot when liquidating. Exchange-traded funds offer convenience, instant liquidity, and institutional-grade custody without storage hassles. Major silver ETFs hold physical metal in allocated accounts audited regularly. However, management fees erode returns over time. During extreme market stress, ETF prices can diverge from underlying metal values temporarily. Authorized participant mechanisms that maintain arbitrage can break down precisely when you most need them to function. Mining equities provide leveraged exposure to metal prices because miners have relatively fixed production costs. When silver rises, profit margins expand disproportionately, amplifying equity returns. However, mining stocks introduce company-specific risks, including management quality, geopolitical jurisdiction of operations, permitting challenges, labor relations, and operational execution. A miner can underperform even when metal prices rise if company-specific problems emerge. The immediate period ahead will prove pivotal for near-term direction. Powell's press conference tomorrow could significantly move markets depending on his tone regarding rate trajectory, economic outlook, and most importantly, institutional independence under political pressure. Any hint of accommodation or acknowledgement that Fed policy faces constraints could weaken the dollar and boost precious metals. Trade policy announcements, particularly involving tariffs on metals or other commodities, could affect the supply dynamics that Goldman Sachs identified as amplifying volatility. Fund flow data released over coming weeks will continue signaling whether institutional and retail appetite remains robust or shows signs of fatigue. Sustained inflows suggest the rally has further room. Reversals would warn that buyers are becoming exhausted. What appears increasingly certain is that silver will not quietly return to obscure background status. The structural factors supporting elevated prices, chronic supply deficits, accelerating industrial demand, monetary policy uncertainty, geopolitical fragmentation, and institutional diversification into hard assets represent multi-year conditions rather than temporary phenomena that will quickly resolve. Even substantial price corrections would not erase these underlying dynamics. Whether this moment represents generational opportunity or classic late-cycle speculative excess depends entirely on individual circumstances, risk capacity, and investment time horizon. Both possibilities remain genuinely live. The same information supports divergent conclusions depending on the interpretive lens applied. What cannot be denied is that we are witnessing an episode in precious metals markets that will generate analysis, debate, academic research, and documentary films for decades to come. The silver squeeze of 2026 has exposed vulnerabilities in global supply networks that most people assumed functioned smoothly. It has revealed the intensity of demand for tangible assets when confidence in currencies and institutions wavers. And it has demonstrated how rapidly sentiment can overwhelm fundamental valuations when multiple powerful catalysts align simultaneously. Whatever direction prices take from current levels, this story demands attention because it illuminates much larger forces reshaping global finance, international relations, and the architecture of monetary systems. Silver has evolved from a forgotten corner of commodity markets into a barometer measuring collective anxiety about currencies, inflation, political stability, and the eternal search for reliable stores of value during uncertain times. That barometer is registering readings that warrant serious consideration regardless of individual investment conclusions. The narrative unfolding right now has only begun its opening chapters. Where it ultimately leads remains genuinely uncertain, but ignoring its implications would mean missing one of the most significant financial stories of this era, a story about money itself, and what happens when people around the world simultaneously question whether the paper in their wallets will preserve their purchasing power. Pay attention, think carefully, and whatever you decide, make that decision based on understanding rather than ignorance of what is actually happening.